Zamuddin says no. Easy unlike delta, perfect, short call position. A short call, a long call is a positive delta position, right, Hiral? The short call will be a negative delta position. And a short put will be a positive delta position. Remember, bullish strategies have positive deltas, bearish strategies have negative deltas. Absolute terms, Anand. Right, Ramesh and Vasudeva are typing. Let me see what they have. Just one moment, guys. All right, no other questions. Should we go ahead? All right. So let's focus on Vega. Now, Vega is the most important Greek. So most of our efforts are spent in managing this guy. So it is this guy which provides us the greatest risk. Okay, what does Vega give you? Vega measures the change in the options premium given a 1 point change in the underlying, a 1% change in the implied volatility of the underlying asset. So if people's expectation change, the options premium is going to change. The options premium is going to change. The implied volatility is going to change. So Vega tells you if the implied volatility changes by 1%, remember the volatility figures are in percentage. Okay, if implied volatility changes by 1%, what is the new premium going to be? What is the new value of premium going to be? This is what Vega tells us. Clear? All right, so just read this slide once. All right. So let's go ahead. Now let's see this. What this has to tell us. Okay. As okay. As implied volatility changes with the dynamics of crowd expectation. Remember, the expectation can be in calm mode and panic mode. These are the two extremes of people's expectation, isn't it? So when everything is normal, no news, nothing, people are not really very what do you call, in panic state. So the volatility is very low. At that point in time, the options premium are going to be very cheap. But as people's expectation keep on changing from calm mode to panic mode, your expectations are going to change for the underlying, right? So because of this change in the expectation from calm to panic, the premium will inflate, or from panic to calm, the premium will deflate. Does that make sense to you guys? Okay. So if volatility keeps on increasing, the time value component will keep on increasing. If the volatility reduces, the implied volatility reduces, time value component also reduces. Vega calculates the impact of these IV changes and helps to calculate the new value of an option. Correct, Deepa. So changes in implied volatility, okay? Changes in implied volatility can have a greater impact on the options premium. Implied volatility changes can have a greater impact on an options premium than the effects of delta, gamma, theta, and rho combined. Got it? So whatever changes implied volatility will have on the options premium time value can be much more than what if effect delta, gamma, theta, and rho have on the on the options premium time value. That is why it is so important to apply the volatility methodology properly and decide about the optimal strategy to be used on basis of this analysis. Got it? Got the gist of implied volatility? Volatility affects only time value component, Karanjit. Okay. Please read this slide. Then I will explain it. Okay, so options, both calls and puts, are always positively correlated to the changes in implied volatility, which means if the implied volatility increases, the options premium will also increase. If the implied volatility reduces, the options premium will also reduce. When buying options, Vega is always positive. Why? Increase in implied volatility will do what? Increase the premium, and that increase in premium, is it going to benefit if you are an option buyer? Yeah, that's why Vega is always positive. Implied volatility increasing would increase the premium, and that is good for the option buyer. Similarly, when you're selling options, Vega is always negative because implied volatility decreasing will decrease the premium, and that is good for the option seller. But increase in implied volatility is bad for the option seller, because increase in implied volatility will increase the premium. Increase in premium will go against the option seller. So the option seller, Vega is always negative. For option buyer, Vega is always positive. Clear? Isn't it simple? Are Greeks really Greeks to you anymore? It's extremely simple. Okay. As professional traders, we do not have preferred strategies. Instead, we adapt to market conditions, selecting the optimal strategy. No, no, this is for positions that you're going to enter. This is in the planning stage, Shrikant. The Greeks will help only in the planning stage. Remember this. Please go ahead. Go and read this slide.
Namaskar, ladies and gentlemen.
Okay, let's begin now. The greater the time to expiry, the greater the time value. Is this clear to you guys? More the time to expiry, more the time value, isn't it? The greater the time value, the greater the impact in changes of implied volatility. So an option which has a bigger time value will also have a bigger impact of changes in implied volatility. An option that has lower time value will have lower impact of the implied volatility, changes in implied volatility. The greater the time to expiry, the greater the value of Vega. Is a So if you see this, the February 3 at the money call option provides 1.05 Vega versus 0.29 provided by the November 12. Now November 12, is it the nearest expiry compared to the far month, that is February? So the far month will have a higher Vega, the nearer month will have a lower Vega value. Which means if when you are in a trade and you bought, let's say, 90 days out, let's assume that Karanjit bought 90 days out and Vasudev bought 30 days out, the same at the money strike option. Okay, the same at the money, just that the expiries are different. So if the implied volatility moves to the upside, the impact is going to be more on Karanjit's option than Vasudev's option. Reason being, Karanjit's option has more time to expiry, that's why more time value, and Vasudev's expiry is nearer, so nearer expiry means lesser time value. Lesser time value means lesser impact of changes in volatility. Lesser impact of changes in volatility means lesser Vega value. Is it clear? Everyone? Perfect. Now, the deeper in the money option, the greater the probability that the option will remain in the money at expiry, small probability of a surprise. So let's say Nifty is trading at 10,660 levels, okay? And we are talking about a 10,000 call option for February, okay? 10,000 call of February. Now, is the 10,000 call option of February in the money or out of the money? In the money. Is it deep or closer to the current market price? Deep. So when it is deep in the money, what do you think would be its delta value? Close to 1, right? It's not going to be completely 1, it's close to 1. So when it is close to 1, that means, let's assume the value is 0.9. 0.9 means 90% probability that it will remain in the money. Correct? So that means there is very, very less chance that it is going to become at the money or out of the money. Correct? Similarly, the deeper the out of the money option, the greater the probability that the option will remain out of the money at expiry. Hence, probability of a surprise is very less, isn't it? I mean, 11,000 call option. Do you think by February it can become in the money? That's another 400, 500 points. The probability is low, right? So lower probability means lower surprise, and lower surprise means lower change impact of changes in implied volatility. In other words, the smaller the probability of a surprise. What is the surprise here? That strike becoming in the money or out of the money. Okay. So in other words, the smaller the probability of a surprise, the less the impact in changes in implied volatility. Therefore, the smaller the probability of a surprise, the smaller the Vega. So basically, Vega is going to be highest for at the money options, and as you go away from at the money options towards out of the money or towards deep in the money, the value of Vega is going to start reducing, because the impact of changes in volatility is going to be lesser as you go outside of the out of the money options. So which means, which option has the greatest impact from a strike perspective? Perfect. Guys are smart. No, add the money, Harish. You all guys are very smart. What is one? No, 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 Ashish. It is indirectly. I mean, for example, your statement is correct, but it doesn't affect us like that. So basically, when you go to panic mode, or let's say when you go to calm mode, that means, are you at one extreme of the pendulum expectation? So so from calm mode, can your expectation only increase? So once your expectation starts increasing, so basically the expectation is outside of one. So when you are in calm mode, that means you are at one standard deviation, edge of that one standard deviation. So as you start coming inside towards the mean, that is calm mode. From calm mode, you start moving towards the panic, greedy mode or panic mode. And let's say you come in the middle of the thing, your Yes, it is crowd psyche. The crowd is what will drive the prices and the time value component of the option. It is the crowd's thinking which is driving the prices. That's why volatility only impacts the time value component. It does not impact the intrinsic value. Okay, and notice how Vega becomes smaller when moving out towards in the money or out of the money. So if you see here, so where is it? So if you see the 500 strike price or the 530 strike price is at the money, the one with the yellow horizontal line, if you see that Vega is 0.29, which is at the money. So as you go up towards out of the money, or as you go down towards deeper in the money for call option, notice how the value of Vega, this is from 0.29 it is reducing to 0.14, and from 0.29 it is again reducing to 0.14 on either side. So that is this statement. Notice how Vega will become a smaller value when moving towards in the money or out of the money away from the ATM strikes. Is this clear to everyone? Why current market price? It's 530. The current market price is given here. See this. The last traded price is 530. That's why. That's why 530 is at the money. Yeah, the strike price. Yes. 530 is the strike price, isn't? So 530 is a strike that is released by exchange, and the current market price is also 530. So isn't it going to be at the money strike, Ramesh ji? Correct. So are these statements clear? Okay, now see this. This math is extremely simple. Go through this math. बहुत ज़्यादा simple है ये Greeks. It's just that you don't understand because this is new to you. The moment you understand what these Greeks are, right, then you'll say अरे क्या ये चिंदी लोग है ये. खाली फुकट इतना टाइम परेशान किया हमको. Simple, right? So basically the current implied volatility is 27%. If the IV drops by 1%, how are the options correlated? Positive, right? Which means IV increases, option premium increases, IV reduces, option premium reduces. What is happening to the underlying? What is happening to the IV? IV is dropping, right? So your premium will reduce or increase? Reduce. By what value? By the value of Vega. Simple. That's it. So the original value was 29.39. 0.16 Harish is from this. So if you see November call, right, it is here. This one. At 0.16 is the Vega value that the Black and Scholes model will give you. Similarly, if IV rises from 27 to 28, the new value will be the old premium plus the Vega value. That's it. And anyways, we don't have to do this math. The software will do everything for us. We just have to understand what these numbers are. Not really. I mean, it's very easy. When tomorrow, the day after tomorrow, you will come to know tomorrow and day after tomorrow how simple it is. Okay, is this clear to everyone? That's all we have in Vega. Now, what I'm going to do is 16 is it came from the Black and Scholes model, Sushila. I'm going to tell you what is the easiest way to remember this. Yeah, options oracle is what we will use. Slide 47. बोलिए आनंद भाई. अरे तो तुम्हारे पास मैनुअल नहीं है क्या? क्यों मिला नहीं? तो ई बुक है ना, ई बुक में लिख लो. और ई बुक नहीं है तो मैनुअल मांग के लो. Okay, I forgot to check. Let me just one moment. I think ebooks for options are still not there. Okay, manuals have been sent, right? Then no problem. Okay. Uh, Okay, let me check the Excel sheet. Hard copy must have been received by you, Sureshji. You haven't received still? Okay, then you'll have to send out an email to s3 at onlinetradingacademy.com. Okay, this is what I wanted to. All right. What I want you to do now is look at the one this rhombus, these rhombuses, and tell me what do you understand by this. Let's see. Okay, so this is moneyness, this is expiry, and here whatever I'm comparing is the different volatility impacts on moneyness and expiry, as well as theta on moneyness and expiry.